In the beginning, like when someone wants to get into investing, the first questions they have are very, very elementary questions, which I have covered on my website. But just to kick this off, I'm going to take two elementary questions. The first one is, what is a business? And the second one is, what is a company? So, a business is anything which delivers repeatedly something which is useful to society, and they do it in return for money. So if you are doing something continuously, delivering a product or a service, and that is being paid for by someone because it is valuable to them, that's a business. And every large organization that you see around you is a business, and these businesses are valuable because they earn a profit over time. So with that, now let's define what a company is. So a company is something which has been created for human convenience. It's a legal fiction, so to speak, and it enables two things. One is that it allows for a lot of people to come together to do something on a large scale, because individuals have restrictions on scale, so to speak. So a company, by having its own identity, allows for people to come together and collaborate. That is the first use of a company. And the second use is that it allows for business continuity. So for example, if I were to start a business, by the time I'm 70 or 75, I might just be uninterested in running the operations day to day. So the transfer then is purely, let's say, family based, or there is no way to ensure that the people who run the business are actually the people who know the business well and are interested in it. But a company structure enables for that to happen. So these are the two elementary things which you should know, that all the businesses that you can buy on the stock exchange are structured in the form of a company, which is the legal fiction, and all of them are businesses, which means that they earn something, which is why you would like to be the owner of a business. So to pick up on what an equity share is, and what stock markets and stock exchanges are, and who's a stockbroker, what's a trading and demat account, you can check out my article. Now I'm just going to swing directly to how do you take investing decisions. So investing decisions are made based on two kinds of schools of thought. There are two ways to analyze what to invest in. The first way is that you completely believe in the fact that the stock that you're buying represents a business. So you evaluate the business and how good the business is, and based on that you buy or sell the stock. The second school of thought is that the stock might represent the business, but the business and the stock are not the same thing. And a stock rises because people want it, and a stock falls because people don't want it. So the second school says that we will just focus on the market. So the second school of thought uses market data. The first school of thought uses the actual business data, like profit, sales, costs, and stuff like this. So I'm going to explain both of these one after the other. I'll start with the school of thought which uses business information to evaluate a business. So this has many steps. The way you analyze a business is you first try to understand what the business is, what it does. So if we were to take the example of, say, Nestle, so we will start with what products does it make. So you can start with your chocolates, your cereals, your biscuits, and stuff like that, and you figure out the economics of all of them. What do I mean by economics? That what they sell for, what they cost to make, and stuff like that, but I will delve into that. So the first step is you understand the business, in which you answer four fundamental questions. The first question is, who are the customers? Now the customer is someone who pays for your product. So who buys chocolates, who buys biscuits, which is all of us. And the second is, what are the products, which is the biscuits and the chocolates and stuff like that. What is the industry? Now the industry is, in this case, food and beverages. Now let's say if you were analyzing a company that makes cement, manufactures cement, now that would fall into the construction industry. Similarly, if you were to analyze ICICI Bank, the industry there is banking. So then you go to the next step, which is geography, which is where does the business have its operations, where do the sales happen. So that's the first step, which is understanding the business. The next step in the analyzing the company based on business data is figuring out whether the business is good at making money. Now let's just back up a little. And why would you want to buy a business? Like, just think of it this way, that you have some money and you're free and you want to do something to make yourself busy, and you find out that a local store that sells maybe sweets is on sale. Now you will want to figure out that what is the profit that store makes, how much sale does it make on a daily basis, monthly basis, annually, what are the costs like, what are the problems it faces, what the competition is, how can it grow, will it grow. So all these things you have to figure out, and most of this comes from an accounting angle. So here I'll just share a quote that I really like. Even though there's a lot of accounting jokes, but if you don't have accounting to tell you where you are, you actually don't know where you are. Because a lot of people in entrepreneurship can tell you very, very rosy stories, and they can, paint castles in air, but accounting is what will show you the real picture. So when you buy a real business, you have to figure out what the numbers are saying. So the question is the business good at making money? Which is primarily an accounting question. So how do you answer that? You answer that by figuring out whether the sales are growing, whether the profit has been growing in the past few years, and further you see the growth on year-to-year basis, if it is consistent, or there are spurts of growth and then there are valleys of just mediocrity. Then you figure out whether there is a lot of debt on the company, like has the company taken a lot of loans, is the company let's say, does it have a stable asset base? Because you would have noticed that at the time of Corona, a lot of companies have folded their operations. That is because the companies are poorly funded and they just run on a line of credit. Now you would not want to be the owner of such a business, because the bank is always calling you for their interest, but you make only enough money to pay the interest. So you work just to stay alive. So these are the things you have to consider from an accounting perspective, just to figure out which company is good at making money, and that's the company you should be buying. The next step is studying the industry. Now, why do we study the industry? It's because you need to figure out whether the industry is growing, how many companies are there in competing with the company you're looking at, is there a clear market leader, is the industry something which is cyclical. So what's a cyclical industry? Like, for example, sugar is a cyclical industry. So it makes money over a period of time, and it has other periods of time where it doesn't make money at all. It's either seasonal, or like, for example, aluminium tends to have a 4-year cycle, sugar tends to have a 1-year cycle. So these are the things you have to know to take an informed decision of when to enter and when to exit. Industries you can study on a website called IBEF. It's India Brand Equity Foundation. That's what I use myself, because it's very hard for anybody to know even 1 or 2 industries really well. So you really have to take the time to study them. So okay, that's step 3 out of the way. So just to recap, first step is understanding the business. Second step is the business good at making money? Third step is studying the industry. And now on to the fourth step is to know the management. So I'm sure you've heard of these scandals that happened in Satyam Computers or in Enron, and now lately in ILFS, or even to some degree in Yes Bank. You would know that no matter how good the business is at making money, if the people running it do not have integrity, then there is no reason for you to be an owner of that company. Because even if the business does make profit, the management will find a way to make it reach their own pockets, and your job as a shareholder is to have it reach you, because that's the reason you're investing in the company, to protect your capital and to grow your capital. Otherwise there would be no need for you to invest. You can just keep it in the bank. So next step is what price to pay. Now I cannot stress this enough. This is the most critical step in investing, because think of it like a test match, and which does not have a 5-day limit. You will have bowlers throw a ball at you every single day, and you can leave all of them, and just after maybe 10 overs there's going to be one ball which has been placed exactly where you need it to be, so that you can hit it out of the stadium. So those are the balls that you need to take a swing at. So that's what you mean by what price to pay. When you figured out how much money the business makes, and you know what price you're paying for one share, you can come to a percentage of how much return you're getting on your money. For example, like just to give a very simple example, when you make a fixed deposit, so you deposit 100 rupees in your bank, so at the end of the year, let's say you get 5 rupees 20 paisa in today's rates, as per today's rates. You need to find a business which is going to grow such that when you invest 100 rupees, you get at the end of the year a profit of at least 15 rupees. On 100 rupees, you get 15 rupees. Now that is a great business. Now, if you can buy that business cheap, then you are probably buying a 100 rupee note for 60 rupees. Now that is the sweet spot, and that comes from spending a lot of time doing your research, looking for companies constantly, finding a good company which has good management and is growing over a period of time, and finally buying it at a discount. So that's the sweet spot on how you make your investing decision. Now the last step within this is when to sell. Now selling is something which a lot of successful investors disagree on what is the best way to approach this. A lot of them will tell you that if you have a great business with a great management and it's growing, you should never sell. Some of them will tell you that when you've reached your target, let's say you wanted to make a return of 4 times over a period of time, and you've reached 4 times, then there's no reason for you to sit tight and don't be greedy. So I think this is something which is very individual, and you have to figure it out for yourself, because if you need the money, then you will have to sell your investment. But if you don't need the money and you think that the management can still execute more and more, grow the profit more and more, and give you more return on your capital, then you should stay put. Finally, on this school of thought, I would just like to add a few suggestions. If you're going to take this journey of being an investor that looks at business data, one website that I would strongly recommend is called Screener. So screener.in is a website that brings together financial data of all the companies listed in India. And let's say you can go there and look at Ashok Leyland or ICICI Bank or Tata Motors, and you can see what their sales are, what they have been over the last 10 years, what the profit is, and so on and so forth. So just spending more time on Screener than you do on Instagram will kind of give you an insight of what kind of profits these businesses have been throwing out. Then if you're going to delve into analyzing a company, the best resource you can use is called the annual report. So an annual report is something which every listed company publishes at the end of the year, and you can download it from their website. Or you can simply Google, for example, annual report HDFC Bank, and you will find it. And just by reading it, it's a very daunting document, but I would say that you should directly swing to a section called management discussion and analysis that will give you most of the stuff you need to know about the company, and then you can read the about us page on the website. This will give you a broad insight, and then obviously look at the accounting numbers and take it from there. I would like to say that a lot of times while researching a company, you will want to skip to a different company just because there's noise around it. Your friend called you and said that I've heard of this company and it's going to make a lot of money. I don't recommend that, because investing is honestly it's like a kind of a craft. It's like handwriting. Like the more you do it, you'll get better at it. It's like carpentry. It's the same as anything that you learn by doing it over and over and over again. So don't quit your analysis on a company halfway, which is also why I would recommend that you should pick a company which is reasonably small, because then it will be easy to understand in the beginning, and you will not feel inclined to skip to something else if the company is in a business that interests you. So which will be individual to individual. So I think that's the way to go in the beginning. And lastly, when we tend to spend a lot of time on a company, like in my example, the first time I read a whole annual report, it took me like 3 weeks to read it. And I felt like I had given so much time to this, now I have to, act on it. So I bought that company, even though my analysis was saying that, this is not a great company to get into, but like at that stage, and I was much younger at the time, I just felt that I've taken so much time and there has to be a reward at the end of it. So I bought the company and I lost a lot of money in it. So don't be attached to the time spent. Spend the time, stay rational, and it's okay to leave a lot of balls and take the right ball to swing at and hit it right out of the fence. So now I'll skip to the second school of thought. The first school of thought, I said there's two ways to make investing decisions. The first school of thought is taking the business and saying that the stock represents the business, and so that's why you analyze the business. So we've covered that. The second school of thought is analyzing a stock on market data. Now this is coming from a lot of people who feel that even sometimes when a business is great, the market doesn't necessarily reward it. So the people who do this school of thought, they say that the stock is the stock and the business is the business, and if we study the data of the market, by data I mean the price, what kind of patterns it creates, and what it was and what it tends to become based on historical factors, then that is enough analysis. So a lot of people subscribe to this ideology, and it works well. There's people on both sides who make a lot of money. Like you would have heard of someone called Warren Buffett, and a lot of other fundamental investors like Prem Vatsa, Monish Pabrai, all these, even Rakesh Jhunjhunwala. These guys are very fundamental driven, which is the first school of thought, that they look at the business. But there's a lot of investors, especially institutional investors, like investors sitting inside banks, handling banking funds. They look at a lot of this market data, which loosely is called technical analysis. So what is technical analysis? They take the pricing data for, let's say, 10 years, and then they kind of put it on a chart, and they study these patterns. Based on the patterns, they find triggers. Like, just to give you an example, let's say that we're looking at the stock of Ashok Leyland. Now let's say the stock is trading at 60 rupees. Now you can create a line which is a 50-day moving average. Now what that means is that it's the average of the last 50 days that the Ashok Leyland stock has been traded in. Now the technical analyst makes a strategy, which is that if the current price line crosses the 50-day moving average from the bottom towards the top, then that is a buy signal, and if it does the opposite, then that is a sell signal. So in such a way, based on charting data, a lot of strategies are created, and you will find a plethora of them, which I feel is even impossible to cover in a master's degree. But just to introduce you to some of them, like the one I just gave an example of is called the moving average strategy. So you can make a moving average strategy with a 50-day moving average, or a 90-day moving average, 200-day moving average. Like there's a belief in the traders in India, which is very, very prevalent, that if the Nifty trades above the 50-day moving average, and then that's a bullish phase for the market. By bull, I mean that it's on a positive upward trend, and if it trades under the 50-day moving average, then it's a bearish trend, which is a downward trend. So the more you study these indicators, the more you will figure out what triggers and what signals of buy and sell are there. So that's one signal that I just covered, the moving average signal. Then the next one that I would just quickly like to introduce you to is called the relative strength index. So the relative strength index makes a ratio of the number of positive trades and the number of negative trades, and then it puts it on a price chart, it puts it on an oscillator chart where the bottom is 0 and the top is 100. So if the price hits 80, if the chart hits 80, then it's supposed to be overbought, which means that once it falls under 80, then you should sell the stock. And in the same way, if the chart falls under 20 and then comes out and let's say hits 21, then that's a buy signal. Now all of these things will make more sense to you when you see it on a chart yourself, which I would say that you can take a look at Yahoo Finance, or there's a website called TradingView. These will give you an insight into this. But I would just say that if you want to take the first school of thought with just some basic common sense and some basic understanding of accounting and business, you can find your way, and even a novice can become good at that by just putting in the time. But my experience on the charting side is that you would need to do a course, an online course or an in-person course, just to understand a few indicators, and the more you do it, then the better you will get at it. Now another way to use market data is that just the way every business in today's day and age uses a lot of data to find signals, whether in marketing, whether in production. So the same thing is happening in the market also. So people download large chunks of historical data, and they find trends within that data, and based on that, then they automate strategies, which is popularly known as algorithmic trading. Now in the last few years, algorithmic trading has moved on from being just a market-based study. So now algorithms are even studying business-based data like sales and profit, like I introduced a while back. And there are some algorithms which even find triggers on news-based data. So if there's a negative news on, let's say, a pharmaceutical company, then the algorithm will automatically sell that stock. Now these are very, very detailed and sophisticated things, but if you're interested in them, I would love to discuss them offline if you write to me. I think that I've covered what I plan to cover in this session. I've introduced you to the basics of what you need to know, which is what's a business, what's a company, and then if you are wanting to participate in the markets, there is an approach in which you look at business data, there is an approach in which you look at market data, and then there's the study of algorithms, there's big data and stuff like that. So with that, I think we'll wrap this up. I hope you enjoyed it, and good luck.